Trump or Obama?
Oh, for me, Obama.
Absolutely. I was joking. I'm not going to put that in.
No, you can. I was going to say, I thought you said this was going to be hard.
Business is moving faster than ever. In tech, it's moving even faster. In order to stay ahead, we need to be constantly learning. This is Driving Change, where we go for a ride with tech leaders to gain insights on their beliefs, habits, routines, and influences. Today, we take a ride with Patrick Meenan, a venture capitalist and partner at Arthur Ventures. On the ride, we talk about the ins and outs of venture capital and raising money.
You're a partner at Arthur Ventures.
I am, yeah.
What is Arthur Ventures?
So Arthur Ventures is a venture capital firm. Our goal at Arthur Ventures is to find, invest in, and support the fastest growing B2B software companies that are located anywhere outside of San Francisco.
Okay.
So typically we're doing that at the early stage.
Yep.
So seed, Series A financings and companies.
Yep.
It's probably about 80% of what we do. There's about 20% that tend to be more mature companies that are raising their first capital round.
Yep.
But for us, the easiest way to think about us is that we're usually investing like $500,000 to $2.5 million
Okay.
in rounds of like 1 to 5.
Okay.
So on the smaller end of that, like $2 or $3 million rounds, you're going to see us either do it all or do a lot of it.
Okay.
To the extent a round gets bigger, we'll probably participate with some other firms.
Okay. So people that are not familiar with venture capital,
Yeah.
or they've heard of venture capital or raising money, can you give me a little high-level overview of what is venture capital? Like, how does it work?
So one is, at the highest level, what venture capital does, or a venture capital firm, is that they provide capital in the form of cash to businesses in exchange for an ownership percentage.
Okay.
So the business gets cash to help grow their business, and the investor gets an equity stake in that business, with the goal of that company essentially having a valuable liquidity event over time.
Okay.
They get acquired, they go public, what have you, and as an investor, your ownership percentage that you have is much greater, when the company has a liquidity event than it was when you invested.
Sure.
So at the highest level, that's what a venture capital firm does, and quite frankly, that's what any investor does. An actual venture capital firm, how they operate is we raise capital from investors. So we raise dedicated pools of capital, which are called funds.
What makes Arthur different? And I think you already did say, like, you guys fund companies outside of Silicon Valley, which already sounds different than most, right? And it's B2B software, is that
exactly.
correct?
Yep.
Okay.
So different's a hard question, right? Because it's different compared to what, and kind of in the eyes of who.
Okay.
Because our limited partners probably think we're different for various reasons than an entrepreneur might think we're different. So just a few things that are really important about our fund is, one, we are a national fund.
Okay.
So even though we don't invest in San Francisco, we do not overly focus on one region past that. So oftentimes we will be confused as a Midwest fund because we're based here, and we are very simply not a Midwest fund. We have multiple companies in Seattle, we're in Santa Barbara, Phoenix, Dallas, Atlanta, New York, Pittsburgh, Philly, Baltimore, Chicago, Detroit, Madison, Minneapolis. You get the idea. We're very national in how we look at things. And we do that very intentionally because we think it provides the best return for our limited partners, but we also think that it provides the best context for our entrepreneurs. We think they deserve a perspective that's not just based within 3 or 4 states.
Okay.
So that's very different, that we're national compared to a lot of funds of our size. We're hyper-focused on B2B software, specifically SaaS, as you referenced, software as a service.
Yep.
So that is one thing that's unique. A lot of other funds will dabble in a lot, and we tend to be pretty laser-focused there. And I would say another thing in how we're quite different is that we run a pretty concentrated portfolio. And what I mean by that is we invest in about 20 companies per fund, which sounds like a lot, but compared to a lot of funds of our size, many of them invest in 50, 60, 70 companies per fund. And for us, we're incredibly intentional about how we build our portfolio.
What are some misconceptions that you find often in venture capital?
I would say the biggest misconception is that pitch decks and stories matter, and capital rounds matter. And I think the biggest thing that matters is building a business that's delivering customer value. So the best financing rounds that we've seen, the most successful entrepreneurs that we've seen, quite frankly, thought about raising capital last. And they didn't care about the TechCrunch headlines.
So it's more about building a good
Exactly.
business.
It's about building a great business.
Yeah.
And it's really easy to get distracted by all the stuff that you think matters, and all that matters is delivering value to your customers and growing a profitable business.
Thinking about challenges and opportunities from an investing side for a tech company that's just starting to grow in the Twin Cities? What are some of the challenges for them in raising money versus being in another location?
From a seed capital perspective, it is harder outside of major tech hubs for entrepreneurs because a lot of times that seed capital is coming from individuals that don't have direct experience in the business they're building.
Okay.
So what I mean by that is if you're a software entrepreneur and you're trying to raise seed capital, there are less other software executives in Minneapolis that are angel investing or seed investing than there probably is in like Seattle or Austin or what have you.
Yep.
You might be raising from someone that made money in commercial real estate or in another industry, and you have to educate them on what you do. I think that is a challenge.
Okay.
In general, I strongly believe that great businesses get funded anywhere.
Sure.
And so I actually think that the market in Minneapolis is stronger than most entrepreneurs probably think it is.
Yeah, so from an opportunity standpoint, being a tech company, emerging tech company in the Twin Cities, what do you think are some of the opportunities there that maybe you wouldn't have in another market?
Yeah, well, I mean, there's clearly, I think there are two interesting things. I think the first one is capital efficiency, which isn't unique to Minneapolis. I think it's unique to multiple geographies outside of San Francisco. It is just a fact that you're able to do a little bit more with less, which means you get to own more of your company. You get to control more of your destiny, which I think is great. And I also think at the same time here you've got a great talent pool of workers.
Yep.
So it's a nice intersection of those two. There's a lot of smart people, and you're able to do more with less. I think it's certainly appealing. I think that you've seen a lot of companies be able to grow very rapidly in a capital efficient manner.
Yep.
What was Sport Engine, now NBC Sports Engine, Lead Pages, When I Work are all great examples of companies that grew pretty capital efficiently, and I think that their location probably played into that.
Yeah. Talent, and specifically like engineering and developer talent, there's a shortage, right? And I think locally the cool emerging tech companies are the companies that where those people type want to work.
Yeah, they gravitate towards it, right?
So I mean, there's less competition because there's less of those companies. So I think that's an advantage for those companies as well.
I certainly believe that if you are a growing tech company in Minneapolis, you have a unique opportunity to be one of a smaller pool of growing tech companies and becoming sort of a place to work and a place that can retain really high performing talent. I certainly think that's true.
Venture capital, raising money, what's the forecast looking for the next 2 years?
For firms or for entrepreneurs?
For entrepreneurs.
I think it looks really strong. 2016 was a massive year. I don't have the stats off the top of my head, but it was a massive year for fund formation.
Okay.
So a lot of venture capital firms raised money in 2016.
Okay.
And I think 2017 is off to a good start there as well. So what that means is that there's just a lot of capital out there that is looking for a home and is looking for great opportunities.
Yeah.
So if I were an entrepreneur, I would feel really, really good because there's a lot of funds that are in the early phases of the deployment cycle, which is typically when venture capital firms are the most aggressive. I also think valuations for companies have rebounded. We absolutely had a period of time where, a little over a year ago, where valuations fell because there's a lot of economic uncertainty for about 60 days, and then people quickly got over it. So if I'm an entrepreneur, I think that valuations are in a good spot, and I think that there's a lot of capital out there looking for great companies. So I think it's a really, really rosy outlook. I really do.
Where do you get your information, when it comes to learning? Is there any podcasts that you listen to?
Some of the stuff's pretty specific to what I do. There's two podcasts I listen to. One's pretty well known, which is the 20-Minute VC, which is run by Harry Stebbings. I just find that interesting because it's really, really short and digestible. Obviously, it's 20 minutes. And I just think it's interesting to listen to how other VCs think. My favorite podcast is actually called Origins. And it's run by a small firm out in New York called Notation Capital. And their whole series is interviewing limited partners.
Oh.
So interviewing institutional limited partners. And the reason it's so interesting is that it's pretty long form, which I like. It's like 40, 45 minutes. But also they
good
just
for travel.
It's great for travel, that's right. But it's also they get folks on that you don't hear from a lot. And so I just find it really interesting. And again, that's pretty specific to my job. But I would say those are two podcasts that I listen to a lot. Very specific to venture capital, but I think they're both really good.
What are some of the favorite books that you've read?
You know, a recent book that I've read that I just am totally enamored with is Shoe Dog.
It's a great
by
book.
Phil. It's just great. I mean,
it's such a great story.
It's just so well, but it's so well written.
Yeah.
I mean, it's a lot of times those books can either come across arrogant or not very well written.
Yeah.
And it was just phenomenal. Just an incredible story, and I just love how long it took.
Yep.
I think that's one thing that's really misunderstood is how long it takes to build a great business.
Yep.
And Nike took decades.
Yes.
Right? You look at even my partner Doug and what he did with Great Plains Software. It was 20 years, you know?
And decades of uncertainty.
Absolutely. And you go to hell and back like 7 times in between.
Yeah.
And so I just thought that was a book I cannot recommend enough.
Looking back, now knowing where you're at now and kind of where you want to go in the role that you're in, if you were to give your 25-year-old self advice, what would that be?
I would say get off the path. So I think a lot of kids go to college, they end up taking a job out of college that they think they're supposed to take, that they hate.
Yep.
So maybe they go become an accountant or something like that because they think mom and dad want them to work for Ernst & Young. And then after that, they think they have to go to business school. And then after that, they have to go become a consultant. They get on this path, right? And the next thing you know, they look up and they're 40 years old and they think, I hate what I do.
Yeah.
And I think I've been really fortunate to kind of jump off the path before I got to Arthur Ventures, because when I joined Arthur Ventures, we didn't have a fund. It was James and Doug saying, we're going to go raise a fund, of which there wasn't a penny raised. So I kind of took that risk. And I think taking that risk and getting off the path was one of the best decisions I made. And so I think if I were to tell or give advice to a 25-year-old, it would be get a good base of experience, which you're probably done by the time you're 25. And then after that, really chase opportunity and don't just do stuff because you think that you're supposed to.
At any given time, I think anybody in business is working on a specific challenge or trying to figure something out. For you right now, what is that?
There are 2 things that dominate my time or my thoughts. One is out of my control, pretty much, and one's under my control. And what's out of my control is we have a lot of great companies in the fund, just understanding their timeline to getting to where they want to go. So really think about the next few years of those businesses and just they're off to a good start. How do they become great? Then the second one is just company identification. We invest nationally. A lot of it's outbound, trying to find companies, and I always think about what can we be doing more efficiently to find companies before anyone else knows they're out there.
Excellent.
2 biggest things.
Awesome.
Right on,
well,
man.
thanks for your time.
I appreciate it.
It was fun.
Thanks for the coffee.
We'll talk soon.
All right. Cheers.
Hey, this is Jeff Martin again. If you go to leadbychange.com, you can see this show and other shows. If you subscribe, you can get early access to new shows and also exclusive content. Thanks for watching.